Today we're going to talk to Matt Karaffa. Matt Karaffa provides insurance for us. He is our insurance agent at Rust Belt Capital. He is very in tune with everything that's going on and has helped us out quite a bit in making sure that we are fully insured and getting the best premiums that we possibly can.
Thanks for joining us today. We are hoping to have a little conversation, get some feedback, pick your brain a little bit on really, you check a couple boxes as an investor and then by your profession in the insurance industry. So we felt like your feedback and experience will be beneficial both for us and for other people considering investing with Rust Belt. So thanks for coming.
Absolutely. Thanks for having me.
I think the big reason we wanted you to come is because you provide the insurance. You're the insurance agent that we go through, and
thus far, keep him on his toes.
Keep
Thus
him on
far,
his toes.
yeah, right.
And so when we're looking at properties and underwriting properties, when we look at our P&L, insurance is a must-have. Adequate insurance, good insurance is also a must-have for us and for our investors. But it's also a big line item expense. It's not negligible. And so it can really adjust how you underwrite a property and whether at the end of the day we say it's a go or it's not a go. And so it's very important to have a really deep understanding of insurance and the costings of that stuff. So that's part of the reason we wanted you to come and talk to us about that. But before we get into that, why don't you give us a background on yourself, how you got into the insurance business?
Sure.
Maybe where you went to school, stuff like that. And
Yeah. Originally from Cincinnati, Ohio, came up to school to Bowling Green State University and been there ever since. When I came up, I was started in the banking world for about 5 years, and that transitioned into commercial insurance in 2015. So been there, it'll be 9 years at the end of this year. Like I said, focusing on commercial insurance. We do a little bit of personal as well at Risk Strategies, but yeah, so that's kind of been the background the last 9 years, and I would say the last 2 of that have been different than the first 7. We're getting into some unique times that we'll touch on both from a micro level and a macro level that are impacting insurance, the way you purchase it, and it's provided now to maybe what people are used to 5, 10, 15 years ago.
Yeah, and you do insurance outside of just commercial real estate. You also do like business insurance, commercial.
Yeah, we're a full independent agency that provides a lot of that, but given my location in Bowling Green tends to be a lot of habitational, apartment, commercial real estate in and around that area, Northwest Ohio as a whole. So yeah, we have markets for other businesses for sure, but we do have a strong presence in habitational commercial property.
And you guys have huge access to a lot of different insurance providers. It's not like just
Selling one product, right?
Yeah.
Right.
So if things are impacted with one carrier, more so than others, it's never a single number because it's constantly changing who we have access to, and we're constantly growing that and managing that. But 10 to 20, I would say, would be the main players, and given circumstances, good access to a few more, depending on what's going on.
which is a lot. That's a lot to have for an insurance agency, from what I've experienced.
And you're with Risk Strategies, is your the insurance agency, and the other, I said you checked 2 boxes, but really you checked 3. You started in the banking world, so you understand at least a lot more than most people. And when we started looking into our underwriting and so forth, so that's a unique situation. That's good.
Yeah.
Well, all right.
So how'd you get actually into the insurance business? Why, or what was appealing about it, or?
Yeah, so one thing I would say, banking, you were helping customers, on the retail side or loan side, home equity loans, things like that. You're impacting them. But one thing that I've grown in the job, now with Risk Strategies is, you mentioned you have to buy insurance for a certain reason. You understand it. It might not be your most excited thing you get, excited about to spend money on, but you at least understand why you need it.
Right, sure.
Hopefully, most of our clients don't experience a loss and how that gets back, but we're there to provide coverage to get your business, your building, whatever, back up and running when the worst happens.
Right.
So if your building gets burnt down and whatever your cash flow is gone,
Yeah.
and you need to come up with $4 million to get your building back, I'm providing a solution to allow to make that happen.
Sure.
And so the value we're providing is a little different than here's a checking account for you or something like that. The value, like I said, the understanding of why you need it is there with most business owners, commercial property owners. You understand why it's there. And providing that gap of giving you that solution to what you need and educating how it works and how it's put together, that's where I find, that's where a big part of my job comes in.
So it's a higher impact.
Yeah,
Higher impact than
absolutely.
just general banking.
Yep.
For sure. Why don't we move on from that, and let's actually talk about more of the nuances about insurance. When I started getting investing and stuff like that, you have to have, when it comes to real estate, you have to have insurance, because the bank, if you're borrowing money, tells you have to have
They require
insurance.
you to.
Okay, right?
Yeah.
They want to protect their investment, which is smart because we want to protect our investment too. But there's things like, okay, so there's liability insurance, there's umbrella policies, there's coinsurance, replacement value, things like depreciated value, all these different types of things, terminology that if you haven't heard before, number one, it's overwhelming. Number two, you're not sure what it is. Number three, am I getting scammed by some insurance guy? I don't know.
Getting scammed out or ending up underinsured, which is a rough spot to be in.
Yeah, can you
that's-
kind of explain some of that stuff?
You hit on a lot of big topics that have large impacts, and from someone who doesn't live it and breathe it daily, might think we're getting the same, but you can have a lot of variation with all those things. You mentioned that all have a different way and they play on the premium. So if you think about from the liability standpoint, that's obviously going to cover if someone alleges bodily injury, property damage, slip and falls at one of your locations and you were negligent somehow, typically we would put a policy together that would have a minimum $1 million of coverage to the entity purchasing the policy. So outside of that, you're going to move into some of the property coverages where you hit on replacement costs. That's going to be the main driver of the premium. And that's going to take into account the way the replacement cost value is created is it's replacing like-kind materials, given the age, type of materials, frame, masonry, combination of both, asphalt roof, 1 story, 2 stories, all of those things that once you say, hey, here's the address, that's up to us to come up with a value of a replacement value to put on the policy that, again, I'm the worst case doom and gloom guy, it burns to the ground or it gets blown up by a tornado, what value could replace that? Similar square footage, number of stories, the way it is now.
Right.
Not, well, if something happens to it, I'm going to do something completely different. You can do that, but it's a different way to value and put the policy together.
So here's a question, and I feel like, especially when it comes to investment real estate, maybe it comes up is, okay, the replacement, I bought this property for $10 million, okay? But your replacement value is like 20. Okay, I don't want to spend that extra money for the extra 10. I just want the $10 million. Like, how does that work? Can you do that? Like,
Yeah.
I mean, those are questions that
So you see that a lot
logically
on the
ask.
personal line side. So if we take and scale it back, you buy a home for $250,000, but again, your insurance replacement cost is $330,000.
Right.
So similar things on the commercial, just, if we're adding or removing zeros, it has some some additional factors in there, debris removal, site preparation, that inflate not just what you could go sell it for, but again, it's in a pile of rubble from a fire or it's gone altogether. You have some increased costs other than just, all right, let's get the builders in there and go. So
Not just green grass.
that example of maybe you got a deal on it, some nuanced factors of if you're only looking at covering your banking, commitment.
Yeah.
So say that's 10 million, but we're telling you the replacement value is 20, and you only insure it for 10. Now you're getting into one of the other things that's come up on the policy that we get a lot of conversation about is coinsurance. So all policies have a variation of it. It can be 80, it can be 90, it can be 100% agreed value. And what's that stating to the insurance company is that you're insuring that building within that percentage of what the total replacement cost is.
Okay.
So $1 million building, that's what I tell you the replacement cost value is.
Sure.
Right.
We have a policy written on 90% coinsurance. The most minimum amount of coverage you can put on that policy would be $900,000
Makes
to not
sense.
have a penalty.
Yeah.
So we take it a step further. My note with the bank's only $500,000.
Yeah.
Right.
I only want $500,000. I'm telling you, you agree. If we had to rebuild it, it's $1 million.
Sure.
You're on the policy, we only have 500,000.
Right.
We didn't meet the 90% coinsurance requirement on the policy. So now you have a penalty. So say you have just something happen to the roof. It's 75,000 to
Sure.
fix the roof.
Yeah.
First thing they're gonna say, well, do we have the right value? We should have had $1 million, or at a minimum 900,000
Right.
insured on the policy, we only have 500. So now you take that loss and there's a calculation,
Apply the same percentage.
same percentage of what you did insure it for, 500,000. You should have insured it for 900,000. 500 divided by 900 times the amount of the loss, that's the amount you're gonna get on a partial.
So on a $75,000 roof that goes to zero, you would only get like 32 and a half or something like that, or
Correct.
37
You would get
and a
that
half.
coinsurance penalty for the time of the loss. So that's the number one conversation, because it's common. I only want to cover insurance on my bank. That's what required. The first conversation we have, because again, I'm thinking total loss, if it goes to the ground, that's how we have to insure it, even though your most probable type of loss
It's a partial.
is a partial. If something happened in the one unit, you have a small kitchen fire, you got 40, 50,000 coverage. Roof, worst case, whole roof blows off, 50 to 100,000 in there.
Yeah.
But the understanding is, I have insurance, I'm covered for anything.
Partial.
Partial, so it's
Yeah.
walking through all those intricacies of
Is
the
there,
policy.
is there ever a scenario that you would tell people that, okay, that might be the right thing for you to do? Or are you always gonna be like, dude, this is probably not a good idea?
There are select circumstances that it would allow,
And this is generalization too,
yeah,
for sure.
that you have to be in full understanding. Typically, when you get into not even when you get into high deductible, because you're still going to have that partial loss. The depreciated thing is still a way to do it. You just have to understand how it works. So say we're good on the coinsurance, but now instead of a replacement basis, we're insuring it on an actual cash value basis. Same scenario.
So you're saying there's two different ways to insure it, replacement and then depreciation basis.
Correct. Those would be the two options when it comes to valuation of the property itself. You can insure on a replacement basis or an actual cash value basis.
Okay, so explain depreciation value or depreciation basis and how that works. I
Yeah,
think
so
you were on
same
that.
$1 million building that we're saying is the replacement cost value. One of the biggest reasons why we don't recommend it is because you asked me, so we're gonna put on a depreciated basis. How much are you gonna give me at the time of the loss?
Depends.
I have no idea.
Yeah.
On replacement costs, I can tell you.
Yeah.
Because we're agreeing it to it, we're putting it on the policy. We can use ballpark terms, 55 to 65% of that replacement cost value is what you would be given on a depreciated valuation.
There's the depreciation, I'm sure you've got, in the insurance industry, your own numbers. But is it similar to tax depreciation on the schedule of, or is it?
I'm not familiar with the schedule and how the percentage goes, but it takes into, a 5-year-old building's gonna have a different depreciated calculation than a 30-year-old.
Okay,
So the roof is only 5 years old.
Sure.
That's gonna be towards that higher 70, 75%.
Right.
More so than a 30-year-old roof, you're gonna get
you've got
the lowest
limited
end
life
of that.
expectancy left
Yeah.
out of that, yeah.
So that claim scenario we talked through on the replacement cost, $1 million building, you insured it on an actual cash value basis and not replacement cost, you have a $100,000 loss on the roof. You're gonna have your deductible, regardless of replacement cost or actual cash value. Then you're gonna take so $75,000 loss minus depreciation, subject to your deductible. That's how much the insurance company would provide at a time of a loss on a depreciated basis.
Not a fun place to be for a risk-averse entity like ours.
And to take it one step further, so that example is gonna cost you, if you have a claim, for conversation purposes, cost you $40,000. The cost of insurance to insure it at a higher value on replacement cost versus that lower value on actual cash value
Right.
is not $40,000.
Gotcha.
It's gonna be more, because you're providing more coverage, but it's not $40,000. It's not like you're
Sure.
saving $40,000 a year
Sure.
to get that lower coverage. It might be $4,000,
Yeah.
$3,000.
Yeah.
Now, actual cash value, that's just, explain that.
That's the
just-
depreciation. In our world, we don't put depreciation on the policy, we put the valuation, not replacement cost, it would be on actual cash value, which essentially is replacement cost minus depreciation.
Would I be correct to say it's as actual cash value at the time of the loss.
100%.
That's the key there.
At the time of the loss,
Yeah.
not when you, because it's nowhere in the policy because you can't determine it.
Right.
If you write the policy and you have it for 10 years,
the loss
you're gonna have way more depreciation.
Right.
Or you might have put a new roof on.
Sure.
So it's very
Okay, so like
variable.
Say you put a $35,000 roof on one building, okay, and we have it on for 10 years, and then all of a sudden
Have a loss.
we have a hailstorm, and that's somehow is the only building to get screwed up. Okay, that's what are you going to do to figure out the actual cash value? It's no longer 35. That was a replacement value, right? And so now you've got the 10 years to depreciate the roof off, which let's say it's like 50%, assuming it's straight line is 20-year roof.
Sure.
So what? They're going to give you basically half of that, is what you're saying, roughly ballparking.
My answer would be, let's write it on replacement costs. I'll tell you exactly what they're gonna do. Depreciated, this is the great conversation because this is how it happens. I don't know.
I have no idea.
We can use that 50
Assuming-
to 70%
Yeah,
number.
assuming that straight line depreciation, I think that,
And
for
trust me,
example, makes some sense, but.
When we get into actual claims of, we can sit here and talk what ifs, it would be close. But at that time, if you have a loss, whether it's replacement costs or actual cash value, the adjuster will get involved, and there's specific calculations, which I think you hit on before. It's not as
Perfectly straight
regimented
line,
as a
yeah.
tax depreciation schedule, but
Yeah.
there's all those factors that go into that would come up with. It's not just the insurance companies going, 40. There'll be a calculation that you would see at that time. But again, the frustrating part is let's do it actual cash value. Okay. There's the conversation because it can't,
So
it's all what ifs.
you're saying replacement superior because you're eliminating a lot of variable
You're
risk.
paying to go replace it, subject to your $1,000, $5,000, $10,000 deductible. Cost you 35 grand, insurance company's gonna give you that minus your deductible.
Yeah. So from a risk mitigation standpoint, replacement's superior because you no longer have a variable, right? We don't have to worry about, we need extra large cash reserves for a what if happens.
Your budget would be your deductible amount of, if you have one roof loss, all right, 5,000. If we have two, for whatever reason, 10,
So from a capital efficiency perspective as well, since we capitalize the way we invest, we capitalize each entity very well. There's very large cash reserves. We don't have to increase our cash reserves, which means inefficient working capital, right? We're not just having
sitting
dead
there.
money. And so it's actually, from an investment perspective, very efficient to buy replacement versus this depreciated basis, even though we could potentially get a marginally lower premium, right?
And that's, I think, the rub, and you hit on that earlier, that the savings are, I don't want to say nominal, but not significant enough to justify.
You want to sit there and
capital
sign
you have to
something
sit on.
saying you're going to guarantee you don't have a loss for 20 years?
Right,
You could probably get your savings back
sure.
by doing it that way.
Long, long time and unknowns.
But I don't
Yeah.
think, knowing what I know of how you operate, that doesn't usually fit.
It's not gonna,
I mean,
that's
it's
not gonna work.
it's
Yeah.
not going to work for anybody who's serious to try to make a real investment that's actually going to make a meaningful difference in
Isn't
their
going to
life.
save a pennies to make
No.
there's other things we can discuss from a premium perspective. It's not on a replacement cost versus actual cash value.
Yeah. Fair enough. So that brings up, a really good point right now. I went to a lot of different conferences around the country, out in Salt Lake City, in Louisville, in Florida, and right now a huge thing, and even we've had conversations at length about this. A huge thing is that the insurance world is going crazy in terms of expenses. Our premiums are going up. Thankfully, you're helping us mitigate that, which we're grateful for. And that's why we have you as a partner and an advisor, right? But I know other people that, their insurance premiums are more than doubling.
Right.
And if they have older Class C assets, which that's all Class C really is a little bit of older asset built in the 70s, 80s, or even in the 90s, their insurance premiums can go through the roof. And so from an investor perspective, maybe you had a really good investment that was working great, everything's perfect, but now insurance has just screwed it up for you.
Eating up.
And then you add in the interest rate stuff going on right now, and then you add in rent growth is stalling out, and it's like, holy crap. But let's talk about the insurance insurance problem? What's going on? Why are insurance premiums going through the moon?
Yeah, so we got a micro level and a macro level, and they're all coming together. In the insurance industry as a whole, where you have liability, commercial auto, commercial property, that's more the macro side that are getting impacted by a lot of things we'll touch on. But starting with the micro specific to commercial, habitational risk, you have, so those 10 to 20 companies I mentioned that we work with, all have a different tolerance and they all have a different experience when it comes to their losses in a certain class of business. So, you know, company A might set out parameters of, we as a company, we've suffered 110% of the premiums in the last 10 years, we've lost X amount of dollars on this class. We're either gonna increase our rates to where we can make it profitable and continue to pay out claims going forward and provide the coverage you need, or we're just gonna say, we're not in this class at all together, and we're out. So that leads to companies making the decision, each one uniquely, that we work with and have to understand. For example, we have one company that won't write any business unless it was, or any commercial habitational unless it was constructed in the last 50 years.
Okay.
If it's on the books at 40 and it grows, you know, that's different. But if it's new business to that company, built 50 years or older, they're out. Some are as low as 10, some are at 20. So then you go, okay, well, I have a 55-year-old building, what do you have for me? Then we go to some of those companies that are the 19, 20, 21st options, which still can provide it, but they're not as competitive as those first 10 because it's older. They have statistical data that they have more losses on older properties. So that's one of the biggest things is you get all these regional, super regional companies all have different tolerances, and that's where some of it's changing, and that's leading into kind of what you as investors and or the owners of that building can do to, I mean, I'm not subject to that. I can't help when, I can't make it a newer building. I can't tell you when the wind's gonna come. I can't tell you when we're gonna have a fire. But what you can control is, you know, your maintenance, your updates. So, you know, if your electrical is 50 years old, you haven't done anything, and your response of, you know, if you have electrical fire, what will you do? Well, I'll fix it when it happens. Not usually a warm and fuzzy feeling to the insurance company.
How much does like our maintenance and capital improvements to a property actually matter to the insurance agency? So say we go out and we buy a complex and it's tired, but we're gonna come in, it's an older property, it's 30, 35 years old, but all new roofs on it, re-side everything, repave everything, just
Steel roofs.
I mean, when we get done with this property within 12 months, you're gonna be like, dude, this is a nice ass place. It might be 35 years old, but it's nice. Okay, so it's 35 years old, but we've done all these improvements. Does that gain us like any favor? And if so, how much favor?
5 years ago, not much. It was other underwriting data that impacted it more so than that. In the last 2 to 3 years, updates outside of the age of construction, updates of roof, electrical, plumbing.
Big ones.
Huge impact.
Interesting.
And that goes hand in hand with what, and I think, I said roof in that, but that's the biggest one because companies.
The steel roofs.
Steel roofs are just roof, either when they were replaced, because what we find a lot is in your situation, you buy a property, someone's owned it for 30 years, has terrible records. You're coming in to buy it and say, hey, when was all this done? They go, I don't know. So now we don't have that information to give to the company. I'm not a fan of guessing, and that's a crazy thing that happens in our world too. That's a different topic of, you know, the information that gets presented of how it impacts the coverage potentially. But yeah, in the last 2 years, if you have what you suggested of it's a tired property, you want to take it from a C or a B or whatever those updates would do for you, would have a huge impact on underwriting of a property.
More than just 10%, probably.
See, now you're going to hold me to a number, and I'm going to give my favorite answer of it depends.
It depends.
But it's because there's no line item of roof replacement, electrical, plumbing. If you check these boxes, it means 5% discount. It's impacted in the overall underwriting of the account because a lot of it's done by square footage, type of materials, but it does, there's some, you know, we talk with a real person. It's not we don't just plug it in a computer and it spits out. We talk to a person on the other side
Who's actually doing the underwriting?
who's actually doing the underwriting.
Yeah.
In our relationship of, no, I can see you, feel you, I'm not just dealing with you through a computer. My job as an agent is to sell your story of what you're doing, how you're doing it, what your long-term play is, to make it
So you're
the most
advocating
pres-
for us.
Absolutely.
Yeah.
And now more than ever,
Yeah.
I think that's important because of what we've already kind of talked about, how crazy.
It,
The price have gone up. Well, to that end, maybe a different way to look at it, of that bucket of 19, 20, 10, 20, whatever, the number of companies out there that you're shopping, with those kind of, call them major updates, does that at least open the door to some companies might say, okay, it's more than X number of years old, we're automatically out, all right? But instead of being limited to 2 or 3 options, if that opens the door to more competition for those, for the insurance, then that has to help, right?
100%.
Man, that makes some sense without putting a specific number on it.
Right.
Yeah.
Yeah, so those updates, and like I said, taking it a step further on the roof, what we've seen with some recent accounts is, all right, your roofs are good, and they're 10 years old, that checks the boxes of within the replacement, but now they're taking it a step further, that if you don't have a preventative roof maintenance plan, or certain amount of assets, readily
Set aside.
available to
Sure.
handle, especially not so much on the 1 to 2 building, but if you have a lot of units over 10, 12, 15 buildings, because they know you're not going to go replace 15 roofs at one time.
no.
So if you have multiple buildings, they want to see a roof maintenance plan of when you're doing your semi-annual or annual checks on all the gaskets, siding, making sure there's no leaks. And then they want to see, all right, that oldest building in the back is 12 years old.
Right.
In 3 years, that one will be replaced. Here's our X amount of funds set aside. The more we can show that on paper and not just an email or, me send it to them, but you have a spreadsheet or you have something
Actual
documented,
plan. Yeah.
that goes a long way. That would be one, if 1A was roof, electrical, plumbing, preventative maintenance plan is 1B.
So I think you're hitting on a huge note right there is, you said sometimes we'll buy properties basically off of a mom and pop operator.
Yeah.
We buy mid-market properties. That means, 4,250 units at a time is our buy box. And, nothing wrong with being a mom and pop operator, but sometimes they don't keep great records. Okay? Back in the day, not a big problem.
Right.
Today, in the environment that we work on or we're working in, from banking to clearly insurance, like being very sophisticated and professional about this and having a business plan is apparently super huge. So we'll buy places without, actual business plans basically being implemented. And that gives us opportunity to create value, but it also, at this current point in
Right.
time, creates a little bit of
And
a
even
hiccup.
without those records, most people do them in some way, shape, or form. You're going to inspect a roof before you purchase an asset.
Of course.
So
yeah.
you're going to have, you might not have the exact year it was done. You're going to know if it was 10, 20, 30, or we're going to replace it tomorrow. You're going to have some spectrum of where it is. We can use
Yeah.
that, again, the advocating. It doesn't just have to be, well, I need the receipt from the installer. No.
Right.
You need to have an idea. You need to have a plan.
Yeah.
It can't just be, I don't know, it's not leaking.
Right.
So to really drive value, it's becoming more important than ever to actually approach these assets, this investing in real estate, as a true business with a true business plan. It's not just buying it and saying, well, hopefully it goes up in value in 10 years.
Yeah, they've had tenants in there for 10 years. It's got to make money.
Right.
I mean, yeah, that's the goal, but yeah, to your point, taking it to the next level of a plan, proactive, all that goes a long way translating into insurance now.
Yeah, and if we're looking at insurance being 10% of your expenses on a P&L, like it could be significantly higher than that. And if you're not paying attention to it, all of a sudden there's another 5%
back and
going
bites you.
away.
And I know I've talked to you about this, and I think probably together, but before, whether you did it on a cost per square foot basis on your estimate for insurance or a cost per door, that number, like I said, 5-10 years ago, would be pretty accurate within a 5% variable.
Yeah.
Today, the last 2 years, I don't want to do that because it could screw up a deal. If you say, hey, what's this estimate at? And I tell you, X amount per square foot or X amount per door, that multiply, and you use that in your calculations to cash flow the deal.
In underwriting.
And then I go get a market, oh, you don't have lithium smoke protectors and they charge more than this, and it doubled what that is. Now I'm
That's
the
a
bad
deal
guy.
killer. Yeah.
And, I'm very conscious of that, I'm gonna do my best, and I'll probably over-exaggerate on the high end.
Yes.
So you can come down,
Always
Yes.
better.
but that's getting harder and harder. It used to be, like I said, within 5%, I could give you an estimate given on what
Pretty
we've
quick.
seen with those companies, but as fast as they're changing their underwriting, I might have one that we just did a year ago, like, all right, and use those same numbers, oh, we're out.
And this is something that's making acquisitions more challenging in this environment. Isn't like everybody thinks about the interest rates going on, but I'm not concerned about that currently as much as I'm concerned about our insurance line items because, okay, are we looking at a $30,000 premium, a $50,000 premium, a $20,000 premium?
Big range.
Like that's a
Yep.
huge range that can really impact what we're saying to investors that we're actually getting. But I mean, generally, when we do that, we try to be very risk averse and very conservative on all of our numbers. But it's part of the opportunity and the challenge right now is there's people who are going to be less aggressive
Yeah.
and not strategically about it. They're just kind of carte blanche it. So
I'd say just to touch on one of the macro impacts that we're seeing is, we talked about those were more unique to companies and, the underwriting process, but one overall that's impacting all companies across the country is obviously we've had some extreme weather events. But you
Yes.
think we live here in Ohio, we don't have hurricanes, we don't have as many tornadoes, we don't have mudslides, we don't have forest. Correct. But those losses are being trickled down to eventually the consumer through a way of reinsurance
Yes.
through the insurance companies. So they buy insurance just like you and I do.
Yep.
Those reinsurance rates are, we talk 20, 30% rise, on the reinsurance, they're 50 to 100%
Wow.
increases.
so reinsurance is when the insurance company buys insurance. on
Yeah,
the
so for
policy.
example, an insurance company local, to the Midwest,
Mm-hmm.
so their biggest exposure is a tornado that wipes out, 5 miles.
Yeah.
And they have a lot of things and they're paying
that
50 to 100 million. So they buy insurance, their deductible, say it would be 50 million, and then anything over that, they buy insurance for. And they pay a premium, just like we do. So their premium's going up, but their retention's also going up, saying, you were responsible for 50, we're gonna make you responsible for 100. And your rate's going up 40%.
Yeah.
So they're having,
That cumulative.
the sea is
Yeah.
rising across
How
the
come
industry.
how come that's happening all of a sudden? Is it just because of the weather events, or do you think?
We call it social inflation. You see some large verdicts with some in the transportation, but people suing in these crazy $100 million settlements. So that the courts system is impacting.
Is there like a example of one that happened recently?
This
Yeah,
would be
a family-
a personal injury
Family
situation.
of 5 in a van gets hit by, pick a semi with a logo on it, and
like a Swift truck or something?
yeah,
Whoever.
and it gets impacted and, there was loss of life or whatever, and your policy limits are only, 5 million, but there's gonna be a settlement out there. Again, the insurance company's the one paying it. Sure. That goes up to 50, it's a crazy astronomical number. It's more state by state. We don't see it a lot here, per se, in Ohio, but there's some states that have a real problem with
And it's called social what?
social inflation.
Social inflation. How much is inflation impacting stuff? Like inflation of, okay, if we're gonna go rebuild some of these properties today,
Sure. Which gets into, as we talked about, the replacement costs and keeping up with that replacement cost
So
as
one-
you go.
So one example we use on that, so the inflation from COVID and everything of the, whatever it got up to 40% on the labor market, or obviously there's gonna be a different percentage, but whatever that number got there pretty quick, less than a year. Insurance companies, as you can imagine, aren't the most, fast acting
Sure.
type, there has to be data, there has to be rate change, things filed with the state. So say 2019 to 20, the premiums that were collected pre-COVID are the same premiums that are paying out today's cost of claims
Right.
at a 40% higher value.
Right.
So you take data that was underwritten at X amount of claims and you increase that by 40%.
Right.
What you were basing it is at an old rate. The cost of claims are at today's rate. There's a difference.
So $1
So
million.
that's taking 3 to 4 years
To catch up.
to catch back up to what they already lost and plan for the future.
It's hitting all at once.
Even more, that's all coming together. And then you pull in the reinsurance, then you pull in the inflation at the company level.
Yeah.
So we had, one company provided us data that if they took pre-COVID claims at today's dollar, it was 42%
Wow.
higher. Same claims, so same roof, same buildings being repaired, 42% higher from 2020 to 23 when the data was run, that they paid out 40%
So
higher
that,
at
that,
labor.
that $1 million building that you talked about for replacement
1.4.
costs, yeah, 1.4.
And they're collecting premium on it.
On $1 million.
At $1 million.
Yeah.
So you get that
Or
impacted.
Maybe 900,000 if they're only, if they're within that 10%.
So what is that, what does that do with like coinsurance?
So the coinsurance, that concept would be the same, but it's to your point of, it's more in the lines of, all right, it was $1 million. Now, the insurance company's telling us we can't insure it less than 1.4
Yeah.
because they have software, we have software that we run.
That's the
that
cost. Yeah.
Today's labor, today's materials, all of that stuff is, I forget, there's a whole breakdown of obviously cost of a 2x4 then versus now.
Yeah.
Cost of plywood, all those little things that get impacted that go into claims went up, so.
And so you're probably going to see more and more of this, more and more people talk about premiums and expenses and stuff like that as 2024 continues on, because like we have stuff that's just going to, our premiums are, we're just going to talk to our insurance company here like October, November, December.
Right.
So it's going to be ongoing throughout this
Yep.
year,
It's constantly changing.
which is, that's probably somewhat feeding into the CPI number of people's feelings too about like, man, inflation is like crazy.
Sure.
Think about that.
Everything, yeah, there's well, not to get too far off track, but people getting pinched, right?
Yeah.
You're feeling it.
I mean, some people, what we talked about is more, you're only gonna see it like the preventative maintenance stuff, that's more of a habitational, commercial thing. But
Sure.
all those other things we talked about, the inflation, the reinsurance, those are impacting you as commercial investors,
Right.
me as individual, our home and auto, it's, yeah, and people are getting squeezed at every
Every angle. Yep. That's right.
angle.
So what can we do as investors? What can we do to, reduce our premiums on this stuff too? Like, is there a value in the size of the company? So Rust Belt Capital is bigger than, we own more than most individuals would own. Is there value when we come to the plate with our size versus when just an individual would come?
Yeah, so from an overall structure as Rust Belt and what they manage and own, some of it that we have to keep in check would be the ownership structure. There has to be common ownership to kind of leverage, if we put it on one policy or anything like that. But going to a company of a property investor and say, here's 3, but we're going to, 5 or 6, as that number goes up, the law of large numbers would come into play and would give you more underwriting impact as we can show a track record of, all right, here's 3 that they've done, they've replaced this, they've did upgrades, they spent X amount, they're gonna do that same structure on this deal going forward. All of that history that we can document and discuss would have an impact. Again, can't tell you,
Exactly.
if you get to 10 properties, it gets you to it. It doesn't work necessarily that way, but some of the historical data of what you've done on prior deals can go a long way.
Right
for
in
sure.
line with that business plan. And it's not just a business plan on the acquisition, how to run the property, but also the maintenance.
Because it's 2 things. There's one thing, you can't change the physical attributes of the structure. Those are pretty finite. So when you pull the auditor, you're gonna know the age, we're gonna know the square footage, we're gonna know the number of doors.
Right.
Some of that is a plug and play.
It
You
is
plug
what it
that
is, yeah.
information in, and it tells us what the general premium is gonna be around. Then the actual underwriting comes in. Who's owning it? How long have they owned it? What's their history? Do they have any claims? What have they done when they've had claims? That is where your experience as Rust Belt can put you a leg up versus Joe Schmo is like, hey, this looks good. Let's give that a try.
Sure.
You have a different story to tell.
Which
Right.
trickles down to our investors too. Like they're going to benefit from the scale and size of the company, which is the whole idea behind this is the scale and size benefits everybody as investors. Because as an investor, you're owning the real estate just like you would on your own individually, but you're benefiting from, there's people with full-time experience that are dedicated to making sure your investment and your assets being taken care of. There's scale and size that you're getting advantages from.
Along with all the other benefits of being an investor, you're not getting the phone calls, you're not dealing with
Yeah.
the day-to-day, the actual operation, which probably isn't a horrible segue. I'm happy to talk more insurance, but I also want to get your take as an investor with Rust Belt and what your experience has been, good and bad.
And why you
Hopefully
why
not
you
too much
chose
on
to
the
invest.
latter.
Yeah, absolutely. Obviously, the initial reason was, local investment opportunity. Obviously, in the real estate, historically has shown to be a increasing in value over the years, and obviously there's some real estate plans that are the quick hitters, the flip and fixes.
Right.
Not necessarily, that doesn't interest me, but learning what your approach was is more for the long term and kind of generating that investment over the years was probably the main thing.
Okay.
That, take X amount of investment, here's our plan, here's our strategy, being very transparent about that and understanding, there was never a doubt of, man, what am I giving my money to? Like, I knew exactly what was going on, the deal, the structure, was gonna be low for a couple years, but here's where we expect it, years 3, 4, 5, and 6 and in the future. So that was probably reason number one. And you kind of hit the second one of, I don't have to answer the phone at 3 o'clock in the morning. Or, knowing that if something does happen, obviously we have insurance in place for really bad things that happen, but for little things that come up, you have structures in place that's all taken care of
Deal with
through
it,
the entity, and pretty much we read an email, see how the good news is that month, and move on to the next one.
How do you like the communication from us?
It's been awesome. Like I said, from pre-investing of kind of what to expect through the actual first year and into the second of, this is what we said, this is what actually happened. All the information in between, even if it isn't necessarily around our specific deals, but what's going on, what we're seeing, what we're looking for.
Yeah.
Kind of, hey, this is what's coming. Like, oh, that's a little different, but I get it.
Yeah.
So all of it's been good.
Yeah.
Great.
Keeping you up to date on the first investment that you made at Rockledge, like that's a little bit of a unique situation, but because it was a little bit lower in cash flow up front, but it was one that we really liked because you step in, you change the operation. There's not a huge need for any type of capital investments. So literally you just operate the property better, and all of a sudden
Take advantage
you
of-
massively get some appreciation out of it right really quick. Now, the delay had to be that we had to turn over legacy leases or whatever, but yeah, I like that investment a lot.
Yeah.
And I think you're really gonna like it in year 5.
Yeah.
For sure. I'm gonna like it for sure.
Had you thought about at all or considered getting into residential real estate on your own, or on a house-by-house basis at all? Or is that
Like I
something
said,
that crossed your mind?
living in a college town, it's always thought about it. But like I said, the deterrent for the single-family homes was, I don't want tenants. I don't want to deal with some of that, like the cash flow opportunity and the long-term play. And, that would have been my extent of looking at that. And then obviously talking to both of you more and like, hey, we have a structure
Right.
set up that gets you in the real estate game, but does a little different. So
How do you like the fact that, like, how we capitalize a project? When we put a project together, I think one thing that we told you is the likelihood of us ever giving you a cash call or a margin call in the finance world terminology is extremely low. Meaning, okay, if we do have a problem, we got money on hand, we're not going to say, hey, Matt, we need an extra 20 grand.
Right.
Like, versus if you do that, if you go and buy single family houses, like,
There's no one
there's variables all over the place. You got to have cash on hand for not if stuff goes bad, but when stuff goes bad. Like,
Hey, you could be in insurance with that mindset.
yeah, super. Is that something that's pretty appealing to you as well?
Yeah, I mean, from the first deal that we kind of talked through of, obviously those were some of the main questions. Hey, this is great. You know, we get through 6 months and we need 6 furnaces and, 2 roofs.
Right.
You know, how'd you count for that? I mean, that was in there.
Yeah,
I forget if it was Rockledge or a different one, but all of that was done. Like most of it, there wasn't anything huge on the list. So obviously that was, check that item of not having a worry of needing to give additional
Right.
funds. Obviously down the road, crazy stuff happens. Stuff can happen. That's part
Sure,
of the risk.
yeah.
But from a underwriting standpoint up front and what that was a huge, checklist item to not have to worry about that.
So what's your end goal? What's your objective when you invest with us? What do you want to see out of these investments that you're making?
Like I said, one of the main reasons I like is, local investment. I'm sure you guys would do the underwriting if it was in a different state or something, it would be different, but I don't know, just that local tie, being able to drive by it, see it, all that. So keeping that local approach to a certain degree, which I think is in the business model, but, you mean for future deals or?
Like, what do you personally want to see out of these investments? Like, do you want to see, cash flow or major appreciation? Or you want to see in the future that these are stable, reliable sources of income that I can depend on to retire on or go on
I think
vacation?
to summarize, to pick one of those, it would be to stabilize for the long term. Similar to, my personal view is obviously we have different retirement avenues, set up. This was just one more way to diversify into real estate, which was probably a bucket that didn't have a lot in it.
Yeah.
For the long-term approach. Now, if the opportunity's there, and it makes sense to cash out and put it in a different deal or
Sure.
whatever, great. But, knowing from our conversations, it would be stable and long-term would be my main takeaway.
Yeah. I think that's what we tell most investors, that we're not trying to flip these things. So if that's what you want, we're not the shop for you.
Right.
We want to create perpetuity.
Not just what we tell, that is our actual business model.
That is,
That is the plan, yes.
Absolutely.
Because we're investing our own money in this stuff right alongside you. If we're not, sometimes in deals, the largest cash investors too.
Yeah, and that's, for what it's worth, I'd like to describe it as you want to be an octopus. You want to have 8 arms or however many, more than one. You get your day job, you get your 9 to 5, but that doesn't have to be your only source of income, right? And creating multiple income streams, if something happens to one, you've got a backup plan, or 2 or 3 or 7, as the case may be.
Yeah.
And I feel like that's
Yeah.
one piece that I like out of it more than anything else, is that, give me the slow, steady for the long haul, and
100%.
that you can plan on, bank on, moving forward.
That, and I mean, your potential for future deals, I mean, the umbrella of what you have set up is already established with Rust Belt.
Right.
And then the deals that flow through that, some are gonna fit in everybody's bucket a little
Right.
different, but it's all gonna be, I would assume that same approach.
That's the idea.
So,
That's how we differentiate ourselves from other
Very much
operators. Yeah.
long term. We don't have interest in taking on a project that we can't hold for, that forever holding period, basically.
yeah.
Yeah.
But
And that always makes me laugh when we put on our business models. It's the kind of 10-year, because it's 10 years or more. And I always laugh at the 10-year, because I feel like if you're running it right and you've done things right, 10 years is kind of the minimum. There are plenty of situations where there might be an out for any number of reasons. But if that's the game plan going in, I mean, I look at these, and I know you do too, as these are long-term holds that it might roll into something else, but that's not necessarily an out avenue. That's a new opportunity avenue to expand and grow our investors' money and the company. That's the whole idea.
yeah, you're building ATMs for the future.
That's
And if you look
Good
at
way to
our
put it.
pro forma on some of those stuff that we've done, when you get to year like 9 and 10, the cash on cash returns without factoring in, refis and being very conservative on growth of rent and stuff like that, it ends up being like 20% or more, which is a huge amount in terms of a dividend and just cash. So you could do a refi, pull that money back out, which on that Rockledge deal, Nate and I were talking over lunch. I mean, as long as everything keeps doing what it is doing, dude, year 5 is
It's gonna be fun.
it's gonna be really nice.
Yeah, absolutely.
So that's gonna, yeah. Well, man, you've done a really good job with this conversation, and like I feel like I've gotten a lot more
Same.
intelligent with insurance. I'm not the greatest with insurance, but that's why we have you.
That's why we have professionals.
Yeah, that's why we hire the people who know what they're doing. How can people get a hold of you to do business with you? And you know, do you have a LinkedIn? Do you have an email, or how should they?
Yeah, email, LinkedIn would probably be the two easiest. It's at Matt Karaffa's the LinkedIn.
It's Karaffa.
Yep, and then the email would be mkaraffa@risk-strategies.com.
Okay, and you'll help people figure out how to get their insurance needs and/or how to save money on their insurance. Make sure that they're insured correctly too. So,
Absolutely.
all right, man.
Great.
Appreciate it.
Thank you.
Thank you. Appreciate your time. All right.